While the world is glued to panicked headlines and most investors are hitting a sell button, a small, quiet group is just watching. They're not following the same playbook as everyone else. While the crowd sees chaos, they see a clearance sale. On this channel, we don't trade headlines, we track signals. And during chaos, the dashboard matters more than ever. While all that noise is going on, the smartest investors on the planet are doing pretty much nothing. They know that the market's first move, the one driven by pure raw emotion, is almost always a trap. They know the real move, the one that can create generational wealth, hasn't happened yet, and they are just guessing. They're waiting for a very specific signal that tells them it's time to act. In this video, I'm going to pull back the curtain on that playbook. I'll show you the three waves of a market crisis, how to spot the signal that separates the rookies from the pros, and how you can build a system to not just survive, but actually thrive when chaos hits. First, we need to get one thing straight about markets. They're driven by people, and people are driven by emotion. When a geopolitical shock hits, a war, a surprise attack, a major political crisis, the first reaction is never logical. It's primal. It's fear. This gut reaction is what we can call wave one. It's a tidal wave of panic selling. The herd, or what Wall Street sometimes calls dumb money, sees those scary headlines and their first instinct is to sell. Their logic is simple: get me out before this gets any worse. They aren't analyzing anything. They're just reacting to the fear of loss. It's a classic behavior called loss aversion, where the psychological pain of losing money feels twice as powerful as the pleasure of making it. And that right there is the trap. The first move in a chaotic market is almost always an emotional overreaction. Algorithms that are programmed to react to keywords like war or conflict start dumping stocks. Buyers disappear and prices plummet, often way more than the actual event justifies in the long run. We see this pattern over and over again. Looking at major geopolitical events since World War II, the S&P 500 has almost always dropped at the start. But here's the key: that drop is usually temporary. Studies of dozens of these events show the market typically finds its bottom within about 3 weeks and fully recovers its losses in around 40 to 47 days. But the average investor doesn't wait. They sell right into the panic, locking in their losses at the worst possible time. They see their account value dropping and think, I have to stop the bleeding. But what they're really doing is giving themselves a wound that was totally avoidable. Smart money knows this. They understand wave one is not the time to act. It's the time to observe. They aren't selling, they're watching, waiting, and getting their shopping lists ready, because they know wave two is coming, and that's where the real opportunity begins. So what is smart money actually looking at during this first wave of panic? They're not watching the news. They're watching the market's own internal machinery. They're looking for signs that the fear has become completely irrational, that the pendulum has swung way too far into extreme pessimism. Think of it like a pendulum. The further it swings toward extreme fear, the more potential energy it builds up for a massive swing back the other way. Smart investors aren't trying to catch the pendulum while it's moving at full speed. They're waiting for that moment it hangs, almost motionless, at its absolute peak of fear, before it starts its inevitable journey back. To do this, they use a few key indicators, not to predict the future, but to measure the market's current emotional state. You've seen these gauges on the channel before, so let's do a quick breakdown of the most important ones. First, there's the CBOE Volatility Index, or the VIX, our fear gauge. As you know, it measures expected volatility for the next 30 days. A VIX spike above 30 signals fear is no longer rational. During the 2008 crisis, it went over 80. A high VIX tells a contrarian that fear is peaking, following the mantra, when the VIX is high, it's time to buy. Second, the put-call ratio. This gauge compares bearish bets, put options, to bullish bets, call options. When the ratio climbs significantly above 1, say 1.2 or higher, It shows that extreme pessimism is taking over. For a contrarian, this isn't a warning. It's a sign that the worst of the herd selling may be finished. Finally, there are investor sentiment surveys like the AAII's. When these polls, which ask investors their 6-month outlook, show a historic number of bears and almost no bulls, it's a clear signal the crowd has given up. During wave one, smart money is patiently watching these gauges. They're waiting for all three, the VIX, the put call ratio, and sentiment surveys, to be screaming extreme fear. When the VIX is spiking, the put call ratio is soaring, and every investor survey shows record pessimism, they know the pendulum is stretched to its limit. The panic is at its absolute peak. And that is the signal that wave one is ending, and wave two, the repricing of reality, is about to begin. This brings us to the most important part of the playbook, knowing when wave one is ending and wave two is beginning. The signal isn't some flashing green light, it's a subtle shift in the market's mood. It's the moment the fever breaks. After the initial shock, the market starts to actually process what happened. The scary headlines start to fade, and the analysts take over. The question shifts from how bad could this get to what's the actual economic impact? Does this conflict really disrupt global oil supply? Or was that price spike just fear? Does this political crisis truly threaten company profits? Or is it a local problem? This is wave two, the repricing reality phase. The market starts to digest the facts, and this is where the real opportunities show up. The signal that smart money has been waiting for isn't good news. It's the absence of continually worsening news. It's a drop in uncertainty. Smart money isn't predicting the bottom. They're waiting for confirmation that fear has stopped accelerating. Markets don't reward certainty, they reward preparation. So, what does this actually look like? The first and most important sign is that volatility starts to die down. After spiking like crazy, the VIX will start to fall, even if the market itself is still down or just moving sideways. This is critical. A falling VIX tells you that the demand for that panic insurance, put options, is fading. The frantic, desperate selling is finally letting up. The market is starting to build a floor. Not because buyers are rushing in, but because the sellers are just exhausted. At the same time, you start looking for divergences. You might see the main stock market index hit a new low, but you'll notice that fewer individual stocks are hitting new lows. This is called improving market breadth. It's a quiet sign that even though the headline number looks bad, the foundation underneath is getting stronger. The panic isn't hitting everything anymore. It's becoming focused on the few names that are most affected, while other parts of the market quietly start to stabilize. Another key part of the signal is what safe haven assets are doing. During wave one, money floods into things like the US dollar, which is seen as the ultimate safe harbor in a storm. But as wave two begins, you might see the dollar's rally start to stall out or even reverse. This tells you that money is no longer just looking for safety at any price. It's starting to cautiously look for a return again. This is the moment. The VIX is falling from its peak. The put call ratio is coming down from its extremes. Market breadth is improving. The dollar is rolling over. This combination of events is the signal. It's the quiet confirmation that the worst of the panic is over and that prices are no longer being driven by pure fear, but by a more sober assessment of reality. This is when smart money acts. They don't try to time the exact bottom. That's a fool's game. Instead, they start putting money to work. Methodically, they start buying the high quality assets from their shopping list, the ones that got thrown out with the bathwater during the panic. They act decisively, while most investors are still frozen in fear, waiting for an all clear signal from the news that will never come. By the time the headlines turn positive, wave two is already over, and the biggest gains have already been pocketed. Acting on the signal in wave two is how you capture that powerful rebound. But the truly strategic players, the big institutions, and the people managing dynastic wealth are already thinking about the next phase, wave three. Wave three is all about the long term structural changes that a crisis creates. If wave 1 is the emotional shock, and wave 2 is the tactical rebound, wave 3 is the slow, tectonic shift of money moving based on new global realities. These aren't day trades, these are investment themes that can last for a decade. Wave 3 isn't about trades, it's about where capital is forced to flow after trust is broken. A major geopolitical crisis doesn't just shake up markets, it reshapes the world. It can destroy trust between countries, turn financial systems into weapons, and permanently change the flow of energy and trade. Smart money understands this and starts positioning for these second order effects. For example, a conflict might expose just how fragile global supply chains are. A theme that could emerge in Wave 3 then might be a huge investment in onshoring, robotics, and domestic manufacturing. The companies that make this shift possible become the long term winners. After a year like 2025 that was so focused on AI, a key theme for 2026 and beyond might be diversification, both in geography and into these more resilient industries. Or think about how finance gets weaponized, like when a country's foreign currency reserves are frozen. An event like that forces other nations to rethink their reliance on a single global currency. The Wave 3 theme here could be the slow, steady rise of alternative stores of value. This is where assets like gold and even Bitcoin find their real strategic purpose. Not as a hedge against daily chaos, but as a long term hedge against a system wide loss of trust. Energy is another classic example. A crisis that messes with oil and gas supplies will always accelerate the push for energy independence. The Wave 3 play here isn't just about buying oil stocks, it's investing in the whole energy transition, from next generation nuclear and green hydrogen to the industrial metals like copper that are essential for electrification. Spotting these Wave 3 themes requires a different way of thinking. You have to ask, what has fundamentally and permanently changed because of this crisis? And where will capital be forced to flow over the next 5 to 10 years as a result? This is how true multi generational wealth is built. It's not about frantically trading the headlines, it's about understanding the deep structural currents that a crisis unleashes. By identifying these long term themes, you can position your portfolio to benefit from the inevitable reordering of the global economy, long after the initial panic has been forgotten. It's how you go from being a reactive trader to a strategic, forward thinking investor. So, how can you put all this together into a practical plan? It's not about having some kind of secret information, it's about having discipline and the right perspective. Here is your actionable checklist for finding opportunity in chaos. First, prepare. Don't predict. You will never ever predict when the next crisis will hit. So stop trying. Instead, prepare. The most important work happens before the chaos. Have a shopping list of high quality companies or assets you'd love to own if they went on sale. These are businesses with strong financials, real competitive advantages, and great leadership. Know what you want to buy before the panic starts. When the market is in a free fall, you won't have the clarity to do calm, rational research. You need a plan in place. Second, ignore the noise, watch the gauges. When the crisis hits, turn off the news. The headlines are designed to make you emotional, which is exactly what you need to avoid. Instead, focus on the market's internal gauges. Create a simple dashboard to monitor your key contrarian indicators. The VIX, watch for it to spike to extreme levels, 30, 40, or even higher. The put call ratio, look for readings well above 1, showing that pessimism is rampant. Sentiment surveys, pay attention when surveys show a historic number of bears and almost no bulls left. When these three line up to show extreme fear, you'll know wave 1 is in full swing. Third, wait for the signal of wave 2. Don't act just because fear is high. Patience is your single greatest weapon. The signal to start acting isn't a rising market, it's a calming market. You're waiting for the rate of change to shift. Watch for the VIX to start falling from its peak. This is your number one sign that the panic is burning itself out. Look for the US dollar to stop its relentless climb. It's a sign that the desperate flight to safety is easing. Keep an eye out for those divergences where the main indexes are falling, but more and more stocks are starting to hold their ground or even turn up. Fourth, execute your plan methodically. When you see the signals of Wave 2 taking shape, it's go time. But don't go all in at once. Start deploying your cash systematically. Buy your first chunk of assets from your shopping list. If the market drops a bit more, but the fear gauges aren't getting worse, deploy another chunk. You're not trying to nail the absolute bottom. You're buying in a zone of maximum opportunity, averaging into your positions as the emotional storm clouds finally start to part. Fifth, think about Wave 3. As you manage your tactical buys from Wave 2, start thinking longer term. Read analysis on the second order effects of the crisis. Are supply chains being permanently rerouted? Is a new technology getting a massive boost? Are new geopolitical alliances forming? Dedicate a part of your portfolio to these emerging multi year themes. This is how you shift from just capturing a rebound to building lasting strategic wealth. This framework turns you from a passenger who's at the mercy of the market's mood swings into a pilot who uses the turbulence to find a smoother, more profitable flight path. The difference between smart money and everyone else isn't some secret handshake. It's not about complex algorithms or inside tips. It's about discipline, patience, and a totally different point of view. While most people see geopolitical chaos and market crashes as a threat, the prepared investor sees them as a rare opportunity. A clearance sale on world class assets, brought to you by Mass Panic. They don't react to the noise of Wave 1. They wait patiently for the subtle, internal signals of Wave 2 to appear, and they position themselves to profit from the long term structural changes of Wave 3. Make sure you subscribe and hit the bell for notifications, because in the next video, we'll apply this exact framework to the geopolitical fractures reshaping the global energy trade. We're going to keep breaking down the strategies that the world's best investors use to turn fear into fortune. Smart money doesn't fear chaos, it waits for it.